China holds over $3 trillion in US dollar assets. Treasury bonds, agency debt, currency reserves. That's more dollar exposure than any other nation, more than Japan, more than the UK, more than the entire Eurozone combined. And for years, the same warning has echoed through financial circles. What if China liquidates? What if they weaponize their portfolio and unleash a tidal wave of sell orders? The dollar would crater, interest rates would skyrocket, the US would confront a fiscal emergency, its economic primacy would vanish by morning. It's been labeled the nuclear option, the ultimate financial deterrent, the single card that could check American ambition. But here's the secret: China can't play it. Not unwilling, unable, because the second they fire that shot, they obliterate their own economy. Not just harm it, but shatter it completely. That $3 trillion isn't a weapon, it's a cage, and America and China are both inside with no key. This is the most intricate financial standoff ever. Two giants, each with a blade at the other's throat, both aware that any move means mutual ruin, and the true fear isn't a sudden detonation, it's the gradual, inevitable unwinding already underway. China knows it's caged. It spent the last 15 years quietly seeking an exit, accumulating gold, forging alternative financial rails, pivoting its economy from the dollar. But the cage is so vast, the exposure so immense, that breaking free takes a generation. The real question isn't if they'll get out, but if the cage will buckle before they do. Let's examine how this trap functions, why there's no easy escape, and what's unfolding now as both powers maneuver toward an exit without triggering the end. First, the portfolio. As of late 2025, China holds roughly $700 billion in US Treasury debt. That's the public number, and it's the lowest in over 15 years. China has been paring back for a decade. In a single recent month, they slashed $26 billion. This wasn't a minor adjustment. It was the most aggressive sell-off in nearly 2 years. It dropped China to third among foreign creditors, behind Japan and the UK. But that's just the surface. China also holds massive stakes in US corporate debt tech firms, banks, industrials. Estimates range from $300 to $500 billion. They hold straight dollar cash reserves, another $500 billion or more. They hold mortgage-backed securities, the same instruments that triggered the 2008 collapse, bought cheap in the aftermath. Current holdings are around $200 billion. They hold equity in US firms through state-owned vehicles. Total US stock exposure is estimated at over $1 trillion. Add it up: treasuries, corporate paper, cash, mortgages, equities. The total dollar footprint sits between $2.80 and $3.5 trillion. The $3 trillion figure is a midpoint, a round number that captures the scale of China's dollar cage. Why does this number matter? It's not just big, it's foundational. This isn't cash China can simply withdraw. It's woven into the fabric of their system. China amassed these dollars over 40 years through one simple mechanism: trade surplus. From the 1980s onward, China ran the largest sustained trade surplus in modern history. It exported everything: electronics, machinery, textiles, toys. The world paid in dollars. Chinese firms took those dollars, swapped them for yuan at local banks. And those banks passed the dollars to the People's Bank of China. The central bank then had to do something with the incoming flood. It couldn't just sit on cash, so it invested. US Treasury bonds were the default choice, the safest, most liquid asset, backed by the full faith of the US government. And crucially, buying treasuries served another purpose. It suppressed the yuan's value. Each purchase meant selling yuan and buying dollars, keeping the yuan cheap. A cheap yuan made Chinese exports more affordable. More exports meant more dollars flowing in. More dollars meant more treasury purchases, a self-perpetuating cycle. China's entire export model was built on this engine. The $3 trillion in dollar holdings is just a asset pilot S, the physical residue of 40 years of export-led growth. It's the national savings. That's the first layer of the trap. Now, the fantasy scenario so many pundits love: China dumps the entire $3 trillion. Here's the theoretical chain reaction. China gives the order: sell everything. All $700 billion in treasuries hits the market at once. The bond market, normally deep and fluid, seizes. You can't absorb that volume without devastating price impacts. Bond prices crash, yields soar. The 10-year yield, now around 4.5%, rockets to 8%, 10%, or higher. The cascade accelerates. U.S. mortgage rates, tied to the 10-year yield, leap to 13% or 14%. The housing market locks up. Home values collapse. Consumer spending, the core of the U.S. economy, plummets. Corporate borrowing costs hit 12 to 15%. Many firms can't refinance. Defaults surge. Credit markets freeze. Banks holding treasuries watch their assets vaporize. Their balance sheets implode. A banking crisis erupts. The Federal Reserve is forced to respond. It must buy the bonds China is selling, effectively printing hundreds of billions of dollars. Inflation, barely tamed, explodes anew. The dollar's external value collapses. Import prices for everything from cars to food double or triple. Inflation hits 20 to 30%. Stagflation sets in, and the U.S. government's interest bill on its debt, already near $1 trillion annually, doubles. A funding crisis forces brutal spending cuts or runaway money printing. This is the doomsday scenario, the financial nuclear option. China pulls the pin, and the U.S. economy is vaporized. Except, the moment China does this, it destroys itself even quicker. Start with the immediate impact. The dollar crashes. Suppose it loses 30% of its value in weeks. That's catastrophic for America, but even worse for China, because China still holds the other $2.3 trillion in dollar assets. A 30% drop means China incurs nearly $700 billion in losses instantly. Its central bank balance sheet, which backs the yuan, takes a direct hit equal to over 20% of its total reserves. That's not a loss, it's insolvency. But it gets worse. China's economy is still export-driven. About 1/5 of its GDP comes from selling abroad, with the U.S. as the top buyer. When the dollar crashes and the U.S. economy implodes, American demand for Chinese goods evaporates. Chinese factories close. Unemployment spikes. And even if Americans wanted to buy, they couldn't afford to because a crashing dollar means a soaring yuan. Chinese products instantly become 40% more expensive. The real killer is the domestic debt crisis. China's financial system runs on dollar liquidity. Chinese banks and corporations have borrowed trillions in dollar-denominated debt. When the dollar crashes and U.S. rates spike, every one of these entities faces a refinancing nightmare. They owe dollars, but earn in yuan. The yuan has just surged 40%. Their debt burden, in real terms, balloons. Many can't pay. Defaults ripple through the system. Chinese banks face collapse. The government would have to print yuan to bail them out, triggering runaway inflation. Finally, China imports almost all its energy, oil, and gas priced in dollars. A weaker dollar means China pays far more in yuan for the same energy, fueling inflation and crippling its manufacturers. So, tally the damage. China dumps its dollars, incurs $700 billion in immediate losses. Its export economy collapses. Its corporate sector buckles under debt. Its banks fail, inflation soars, and social stability fractures. All of this happens faster than the U.S. collapse because China's economy is more fragile. The U.S. has deep capital markets, a diversified economy, and a central bank that can print the world's reserve currency. China has none of these. When the trap is sprung, China is annihilated first. This is why the $3 trillion isn't a weapon. It's a hostage situation where China is its own hostage. The nuclear option is a suicide vest. Both sides know it. So what is China actually doing? It's executing a slow, decades-long escape. The strategy has three parts. First, gold. China has been stockpiling for years, building one of the largest sovereign gold reserves. Second, alternative payment systems. China built its own international payment network, SIPS, as a yuan-based alternative to the dollar-dominated SWIFT. It's still small, handling about $14 trillion annually compared to SWIFT's $150 trillion. But it's growing fast. China has also set up currency swap lines with over 36 countries: Russia, Brazil, Saudi Arabia, others worth more than $500 billion. The goal is to create a yuan trading bloc where oil, goods, and services are settled in yuan, bypassing the dollar entirely. But there's a problem. This takes decades. You can't force the world to use yuan. It only works if it's more convenient than the dollar. And right now, it's not. Dollar markets are deeper, dollar contracts are more enforceable. Yuan trade settlement has grown from nothing to about 7% of global trade. At this pace, it will take 30 years to reach meaningful scale. China may not have that long. Third, China is trying to reorient its economy from exports to domestic consumption. If Chinese citizens buy more of what China makes, the need for export dollars falls. This has been policy since 2013. Consumption as share of GDP has risen from 38% to over 50%. But this creates a new dilemma. As Chinese wages rise, its exports become less competitive. Factories move to cheaper countries. China's trade surplus is already shrinking, meaning fewer new dollars flow in. But that doesn't shrink the existing $3 trillion trap. China is stuck. It can't sell without crashing the dollar, so it must hold. The timeline for escape started in 2008, after the financial crisis revealed China's vulnerability. 17 years later, they've made some progress. Gold reserves are up, yuan usage is up, Treasury holdings are down, but they're only about a quarter of the way to freedom. At the current rate, full escape takes another 20 to 30 years, until 2050 or beyond. But here's the critical uncertainty. Can the dollar system last that long? The U.S. is adding $2 trillion to its debt annually. The national debt exceeds $35 trillion. Interest costs are consuming ever larger shares of the budget. The dollar's reserve status is slowly eroding, not because China is attacking it, but because America is debasing it from within. If the dollar collapses under its own weight before China escapes, China suffers catastrophic losses. This is the race. And right now, China is losing. It needs 20 years. The dollar's structural decay suggests a crisis in 5 to 10. China is trapped. It can't dump dollars without self-destruction, and it can't hold them without being destroyed when the dollar fails. A lose-lose bind, and the U.S. is trapped too. American policymakers know China holds $3 trillion. They know that pushing too hard, imposing severe sanctions, freezing assets could force China's hand, triggering mutual ruin. This is why U.S. financial warfare against China remains restrained compared to Russia. When Russia invaded Ukraine, the U.S. froze $300 billion in Russian reserves. It can't do that to China. Why? Because China would retaliate by dumping its holdings, ensuring mutual annihilation. So China's dollar hoard acts as a deterrent, constraining U.S. policy. It's not a sword China can wield, but a shield that limits how far America can push. And Beijing knows it.